When you're alone, you can travel faster, but when you're together, you can travel far. And that's what we're going to do on today's episode. We're going to take you far beyond the headlines to help you position your investments properly with a profitable outcome that takes you far financially. I'm Ron DeLegge with ETF Guide, and it's great to see you again. So let's get right into it without further ado and take a look at some charts that I want to share with you. And let's start with the stock market's mood. This is basically a pulse. And of course, we've been in greedy territory most of the year, but now we're starting to get closer to that fearful territory. Yes, financial markets have been selling off over the past couple of weeks. And this, by the way, is completely normal. I'm going to show you a chart explaining to you why that is the case. But right now, the market is neutral. And we always look at stock prices as the single most important indicator of public psychology. Now, I asked you on ETF Guide Community tab, what is your biggest fear since we're discussing fear? And 84% of you said running out of money during retirement or a large unknown external financial crisis. Well, these are both legitimate concerns. And by the way, asset allocation and diversification alone will not fully hedge you or protect you against these risks. You have to invest with a margin of safety. More on that in a second. Our next slide looks at the S&P 500 and the ETF, one of the ETFs tracking it, SPY, versus the VIX, which is a measure of fear in the stock market, S&P 500 to be specific. And you can see I've got three circles here, three red circles. I've got the high point of fear, the low point of fear, and then where we're at right now. This is a 2023 chart. You can see that we're just still much closer to the low point in fear than we are to the high point in fear. So I guess you could say if you're looking at things from a bearish perspective, there's a lot more upside in the VIX and a potential sell-off in stocks. We're still not really anywhere close to the fearful levels that we were earlier this year. Now, how about this for before I share you another scary chart with you, this gives you some historical perspective on S&P 500 when it's up 10% or more at the end of June. How did it do? How did it end? And how did it behave? Well, you can see that yellow highlighted area shows you where we're at right now. This takes a look at the history of S&P 500. Every time it's done what it's done in 2023, going back to 1955, this is pretty typical. We have a sell-off in stocks, or what they call consolidation. That's a friendly way of saying sell-off. Boy, I love market technicians with all of their verbiage and terminology. It's pretty fantastic. And you can see there, though, that end point of the average ending almost up 25%. So that's just history. I'm not going to say, and I don't want to mislead you into thinking that it's going to follow this exactly. But again, it's just historical perspective. And what we're going through right now in terms of stock market correction is totally normal. Here's a scary chart. This is Hawaiian Electric Industries, which has been embroiled in a total mess. Obviously, the wildfires in Maui being the start of all of this. And this shows you that safe stocks are always safe until suddenly they're not. And this takes a look at Hawaiian Electric Industries versus S&P 500 utilities. And it was doing just about the same as XLU until the wildfires struck. And you can see how quickly things can suddenly change. If you have big positions in individual stocks, and especially investments that you may think are safe, and the Wall Street Journal highlighted this in an article released on, this was on their, I think on their app, Hawaiian fires turn safe investments into a big risk. And it mentions here utilities are supposed to be a state investment. Well, Hawaiian Electrics is down more than 66% since the Maui fires started. This could be a similar situation to what PG&E faced here in California in 2018, I believe, when they went bankrupt. because of all of the lawsuits facing them because of a wildfire situation. And this could be possibly the future of Hawaii Electric. Certainly, we don't hope to see that, but this is just a stark reminder for all of our viewers of, again, making sure that you're using the proper investment framework for your investments. You've got 3 buckets, as I teach: the core portfolio, the non-core, the margin of safety. Do we know where individual stocks belong if you're going to invest in them? If you're going to invest in them, where do they go? Well, they only go in one place. That's in your non-core portfolio. That's the part of the portfolio that's always earmarked for higher upside potential. It's also higher risk. And if this part of the portfolio blows up because of a Hawaii Electric situation, it's not going to blow up the entire portfolio because that portfolio is contained. That non-core bucket is not going to impact the margin of safety or the core portfolio, right? And so this is the framework that I teach. Now, the margin of safety is a very important aspect of protecting your capital. And it's important that you understand that there's 3 things that your margin of safety should do. It should protect your capital. So that means 0 chance for any market losses, 0 volatility, and it also provides you stability. So those are the things that your margin of safety does. And our margin of safety tool, I built this at etfguide.com. I want you to use it. I know it will help you. And it's just common sense to protect your money, to protect your valuables. This tool will help you do 3 things. Number 1, it's going to help you calculate how big your margin of safety should be based upon your situation. It's going to give you a target. The next thing it's going to do is going to help you implement your portfolio's margin of safety, helping you make sure that you're using the right instruments or investments that meet the minimum standards of safety, because there's a lot of investments that pose as safe investments, but they're not. A perfect example is utilities, like we just saw. They pose as safe investments, but they're not. They don't meet that minimum definition of minimum standard of safety. And then, of course, you monitor your portfolio safety. Here's another example of an asset that's sometimes sold as safe: treasuries. Well, take a look at this. This is from Charlie Bolello. The past 3 years, we have the 10-year treasury bond on pace for its 3rd consecutive negative year. With data going back to 1928, that's never happened before. We are in historical times. And this is, again, a very, very important reminder and a public service announcement that bonds are not safe, even government bonds. And some of you on this channel in the comment section continue to get this wrong. You continue to insist that bonds are safe. Well, all you got to do is hold them to maturity. Well, the fact is that most investors don't own bonds, individual bonds. They own a bond fund. And those bond funds are constantly being replaced as they mature with new bonds. So there is no maturity holding period that you're holding to. But beyond that, bonds in any form, whether it's through a bond fund or through an individual bond, have volatility. They can and do lose value. They can and do lose principal. And so this is very important. And then, again, another reminder why bonds, and even government bonds, do not meet the minimum standard of a margin of safety asset. Let's take a look at S&P 500 industry sectors. So far, we got 7 up, 4 down. And the top 3 continue to lead: XLY, XLK, and XLC. That's pretty bullish, by the way. We got more S&P 500 sectors up than down. Here's an interesting chart that takes a look at Social Security outlays and revenues. And this I've highlighted in the square. This highlights by 2033, 1 year earlier than previously projected by the Congressional Board Office, is CBO, the Social Security Trust Fund is going to run into some solvency issues. It's going to actually run out. And that's by 2033. That's not a long way away. That's just in 10 years. So this is not a 25, a 30, 40, or 50-year problem. This is a now problem, folks. And I asked our audience what you think about this. Are you worried about Social Security solvency? 61% of you said yes, and 39% of you said no. So the vast majority agree that this is a problem. I agree with you. And there are going to be some cuts, yes, but I don't think they're going to be major cuts. I think the bigger issue is the increases in taxes that are going to be needed to fill the gaps. Here's another chart. Well, not a chart, but something from the Cato Institute that I want to share with you that just shows you how much of a financial burden Medicare and Social Security have become. These are what's called unfunded obligations. And right now we're at $80 trillion. And that's the difference between the present value of total government receipts and total non-interest government spending over the next 75 years. There's some massive imbalances. And 95% of the total non-interest unfunded obligation is being driven by two things: Social Security and Medicare. And a much smaller part by the railroad, retirement, and black lung benefits. So you can see here, Social Security and Medicare are consuming so much resources, financial resources of the government. And then, of course, we didn't even show you any charts about rising interest rates and all of the cost to carry that interest with $32 trillion in national debt. That's not even included in these figures. And so this is why I remind you that it's so important to position your money properly. We'll help you do that at ETF Guide. Become a free member. We've got online classes, online training. These are the things that we teach you. We got invitations to our live retirement workshops. Those are free. You also get my weekly email. I've got links below to sign up. And again, it's a free membership. You can also get access to our online classes. You cannot buy the online classes or get any access without the free membership. Key takeaways: S&P 500 sectors are still more bullish than bearish. That's good. We see the greed fear index is now neutral. Will we get to fearful readings? We're halfway there. And with September and October, this is basically, historically speaking, a weak period for the markets. So we're likely to see an increase in volatility. And that's why I always remind you to always invest with an adequate margin of safety. That tool at etfguide.com that I built will help you to do that. And then keep shifting money into the tax-free zone to avert the imminent threat of skyrocketing U.S. tax rates. And I've told you this so many times on this channel. You are going to be likely, like me, in a higher tax bracket in retirement. These are not the days of the 1980s or the 1990s or the 2000s when tax rates were in a decline, when it made sense to overload your 401k plan and your traditional IRA and your 403b and all your tax-deferred programs, where it made sense to overload them and overfund them because, well, you're getting the tax benefit or tax write-up up front, and then when you pull it out, you're in a lower tax bracket. That was true back then. Our generation is a whole different ballgame. We're going to be in higher tax rates ahead. And listen, there's smarter people than me that see this. David M. Walker, the former U.S. comptroller of the U.S. government, he has said this. He's written 2 books about it. So he sees it. There's other folks that see this. You don't need to be a genius to see this, but the most important thing I need you to understand is start positioning your money every single year. Not a year should go by when you're not repositioning money into the tax-free zone. Roth IRA conversions, Roth IRA contributions, Roth 401k contributions if you qualify. And if you don't qualify, there's other tools that you can use beyond Roth, those of you that are high income earners, in order to get your money into the tax-free zone. Well, that does it for today's episode. Hit some of the links below, get in touch with me, and we'll see you on the next episode. Thanks for watching.